Hey everyone, it's Anthony Gerbi, and I am back with my Thursday Thoughts. I want to thank Kim for stepping in while I've been gone, and I have been gone on paternity leave. My wife and I actually welcomed a newborn baby girl just a few weeks ago. Everybody's doing great. We're so thrilled to be parents, and in honor of that, I wanted to do a segment on my Thursday Thoughts for the next 26 weeks based on a book that Stein Financial Group got me for our daughter, the ABCs of Finance. So I'll go through one a week, and I'll take that term, whatever A is, I'll throw it up here in a second, and relate that to something that's going on either in the news or something that you should be paying attention to. So let's start with A. A is for asset. And this is actually a great segue to talk about Silicon Valley Bank, which had some problems with their assets lately, right? And an asset would be a bank account, a retirement account, a house, just to define the term for you. But more importantly, the banking industry has gone through some turmoil lately, starting with Silicon Valley Bank. Now, I won't get into the whole backstory here. I don't have time for it. But basically, Silicon Valley Bank made some bad decisions with their management, and their depositors said, "We don't really trust you anymore. We'd like our money now, please." Now, the way banks work, if enough depositors come to you all at once, i.e. a bank run, you don't have all of that money just sitting in your vault to pay them out. You've got it tied up in other things because that's how you make money as a bank. Well, that's what happened, and Silicon Valley Bank just had to kind of throw up their hands and say, "We don't have it, we're bankrupt." That sent shockwaves through the market. That sent shockwaves through the banking industry to say, hey, if this can happen to them, why can't it happen to us? Or why, from a depositor's perspective, why do I feel safe with my money at my regional bank down the street? Well, first off, the federal government has stepped in and provided some help here. So I'm not worried. I have my money at a regional credit union in the town I grew up in. I'm not worried about it. Plus, you have FDIC insurance from any account up to $250,000, or any bank, I should say, up to $250,000. That covers a lot of us right there. But as a market event, this has definitely caused some choppiness. We do think it will be short-term choppiness. For example, Silicon Valley Bank's assets were recently bought by another bank for a discount because, of course, the Silicon Valley's in bankruptcy. But that is a good sign that it wasn't that the accounts at Silicon Valley Bank were so bad. It was the bank's management of its money-making activities that didn't work out for them. That does not mean the whole system is unstable. That means Silicon Valley Bank was unstable. There are certainly going to be ripple effects of this. There may be more regulations, there may be more legislation, but we do feel that the market consequences and the banking consequences will be shorter lived, that this will be ultimately, it's a flippant term, but a blip on the radar. So in terms of your assets at your bank, I'm not a banker. I can't speak to the health of any individual bank, but it does not seem like a system is ready to come down like some people were panicked and worried about. It seems like Silicon Valley Bank probably got what their poor management deserved. And that's not a fun thing for their depositors, but it sounds like they'll be made whole or mostly whole, which is somewhat of a happy ending. So I'm looking forward to this series. Thanks for your time today, and we'll see you next week.